another lesson. In this video, we are going to look at a past exam that was tested by KASNEB, and we are specifically looking at an exam that came in August 2023. Now, we shall look at question number 1, and the question number 1A is asked like this: outline 4 limitations of profit maximization as a financial goal of a firm. So we need first to understand what is profit maximization. We're saying that the profit maximization goal is the idea that a business should make as much profit as possible. This is a common goal for all business. This is a common goal for many businesses. They are there to make as much profit as possible, but it has some limitation. It has some limitation. Now, the first limitation is the definition itself about profit maximization. Look at definition of profit. Definition of profit. By this we mean that the precise meaning of the profit. The precise meaning of the profit maximization is very unclear. Is unclear and ambiguous. Why? Does it mean the profit in the short run or in the long run? Yeah. Does it mean short or long-term profits? Long-term. Or does it mean before or after tax? After tax. Is it total or net profit? By this we mean that you can maximize profit before tax, but the tax rate is too high such that you find most of the income goes to tax. Yeah? You can be talking of a short-term and a long-term profit revenues. So the definition itself is somehow confusing. 2, time value of money. Time value of money. The profit maximization objectives does not consider time value of money. Does not distinguish between returns. received at different times. At different times. In other words, we are saying that it does not consider the time value of money. Does not consider the time value of money. The money received today is assumed to be of higher value than what you anticipate in the future. So that is a limitation when it comes to profit maximization goal. Number 3, another limitation is that profit maximization also leads to the production of too many products. The production of too many products that is of no use. That is of no use. Your aim is to get profit, and in such motives you are tempted to produce more. And so this one, when you produce too many products, you are seeing that this will create wastage and destroying of raw materials. Limitation number 4, we are talking about it ignores risk. Ignores risk. Here we are saying that a decision solely based on profits, would be unfair or unfavorable. Because in pursuit of profit, risk involved may be overlooked. Finally, we are talking about the product quality. There is a potential to decrease product quality in pursuit of profit maximization. So those are the limitations when you come to profit maximization goal of the firm. Part B was asking you evaluate 4 features of preference shares as a source of capital to a firm. Now, we ask ourselves, what are preference shares first? We say that preference shares are a type of hybrid security that combine the feature of debt and equity. They are issued by the company. To raise capital, but the preference shareholders are entitled to a fixed dividend and offers a fixed dividend payment, as well as their priority over common shareholders in the event of liquidation. This kind of shareholding is very attractive to business people who want to have a constant revenue or constant cash flows, because when you have acquired preference shares, whether the company make profits or not, you are entitled to a fixed dividend. That's why we are saying that it is a hybrid. It combines both debt. You see, a situation where you are paid fixed is like you're paying interest. That is bring a factor of debt, and also equity, in the sense that it is providing capital, and they are considered fast when the company goes into liquidation. Liquidation is just winding up of companies. So some features of these preference shares include: one is that they have fixed dividend payment. That is the paramount and the most important features of preference shares. By this, we say that preference shareholders are guaranteed to receive a fixed dividend payment, regardless of the company's profit. Now, that's the first feature of a preference share. Next is that they are priority in liquidation. When companies are winding up, they are paid first before the shareholders are compensated for their capital. So we are saying that in the event of liquidation, preference shareholders have priority over common shareholders, in terms of receiving the investment back. In receiving the investment back. Now, another feature of a preference shareholder is that they have no voting rights. In other words, they don't participate in the running of the company. So we are saying that preference shareholders typically do not have a voting right and a say on how the company is run, They cannot remove the auditor, they cannot remove the directors, so they're just there to receive. Something else about preference shareholders, they are convertible, can be convertible. So we are saying that preference shares can be converted to common stock. Preference shares can be converted to common stock. So here we are saying that this gives investors option of converting their investment into equity. Finally, we are saying that preference shares can be callable. What do you mean by this? We are saying that this means that the company can buy them back at predetermined price. So, in other words, you're saying that if you don't want preference shareholders, they can as well set some funds and buy them off. The same thing is for companies to buy on their own shares. They have to go to the market, or when companies are listed, you have to go to the stock market and participate in purchasing like any other person. But with preference shareholders, this one can be agreed upon by the board of management, and that's why you're saying they are callable. Otherwise, those are the features of preference shares. Now we move on to the part C of this question, and you are told that Marker Limited is considering raising funds for an expansion program through rights issue. The expansion program is expected to cost 20 million. The company has currently issued 2,400 ordinary shares. So these are the shares that currently exist, which are currently trading for shillings 30 each. So this will give you the current market value, 2,400 times 30. The board of directors have proposed an offer price of 25, rights issue. The funds to be raised will be invested in a project which is expected to generate net operating cash flows of 6 million each year. This cash flows is annual over the projected useful life of 5 years. So 6 times 5, 30 million. The salvage value of the project after 5 years is estimated to be 5 million. The cost of capital, or the required rate of return, is 12%. Now, you're supposed to, the question is asking you, find the CAMRIGHT price per share. The CAMRIGHT price per share, this is the value, the price per share after the right issue. So if you want to find the come right price, if you want to find the come right market price, you need to know the market price before the issue, market price before right issue. You add the net present value per share, net present value per share, so that you get the price of the share after the issue. Now, how do you get the market price per share before? This one is already given in your question. So what is difficult here, and what we need to calculate here, is the net present value. So we need to find the present value of cash inflows. You have been told that we shall have 600, it is 6 million. Let me see. Yeah, 6 million. This is 6 million multiplied by present value interest factor annuity of 12%, 5 years. This gives you 6 million multiplied by 3.6048, and this is 21,628,800. At the end of the period, there is a terminal benefit of 5 million. You are told that the project after 5 years will have an estimated salvage value of 5 million. So we need to look at their present values. Present value of terminal benefit. Terminal benefit. This implies that you need 5 million multiplied by present value interest factor, 12%, 5 years. And this implies 5 million. 5 million times 0.5674. 5674 gives you 2,837,000. So add these two. This is for cash flows, the present value of cash flows plus the present value of the terminal benefit. This gives you 24,465,800. And there is an initial investment. Look at this. How much are they investing? You are told that this project will require 20 million. So we subtract 20 million here. 20 million. This is the initial outlay. It therefore implies that we shall have the NPVs here will be 24 million minus 20 million. This is 4,465,800. So let's look at NPV per share. NPV per share, the total NPV is 4,465,000. How many shares do we have? You have already been told here in the question that before the rights issue, the shares were 2,400,000. Come here, get 2,400,000. This gives you 1.86. It therefore means for you to get the come rights price, you have been told from the question, look at this. The current selling price is 30. So before the right issues, the shares were trading at shillings 30. So 30. I add NPV per share, 1.86. So the come right price will be that 1.86. Good. Next, you're supposed to look for the number of rights required to buy one new ordinary share. Here, we need to find current number of shares, divided by new shares to be issued. This will give us the number, the rights required to buy 1 new ordinary shares. Now, new shares to be issued, new shares to be issued is the same as the total amount that is needed, which is 20 million, divided by the price of 1 share, which is 25. It therefore means when you take 20 million divided by 25, it requires 800,000 shares. So substituting my formula there, it means I will have the rights here is 24 million divided by 800,000. When you cancel this and this, this was 200. The total number of shares were 2.4 million. This is 2.4 million. We are talking of current number of shares. It is 2.4 million. Divided by the new shares to be issued. I've already calculated here. So when you divide this one and this one, you find 3 shares. That is what the examiner wanted. The number of rights required to buy new ordinary shares. Next, you are asked to look for theoretical X rights market price per share. Here, if you remember the formula, we only need to know current value of equity, current equity value. We add the new fund that is needed, new funds to be raised, divided by all the shares. We have current number of shares, plus new shares to be issued, Now, this one is as good as done. Equity, we have 2,400,000. Multiplied by the value is 30. New fund that is required is 20 million. We have found that the current number of shares are 2.4 million. And the number of shares that are required is 800,000. So when you divide this one, you get shillings 28.75. That is the theoretical X rights market price per share. Now, theoretical value of each right, we call this VR. You just need to get market price per share minus the theoretical X rights. So here the current market price per share is 30 minus 28.75. This gives you 1.25. Good. Now that is as good as done. We go to the last part. Here you're told that evaluate the impact of the right issue on the value of wealth of an existing shareholders. Who owns? We are talking of a certain shareholder who owns 1,200 ordinary shares in the company and 15,000 in his saving account under various options available to him. So, what are the options? What are the options first? What options does he have? The first option is either you exercise the rights. The first option is you buy the rights. That means exercise the rights. If he assumed to exercise the right means for every 3 shares, he get 1 new share. And how many shares does he have? He has 1,200. So how many new shares shall he get? Therefore, the shares is 1,200 times 1 divided by 3. So he shall have 400 shares. What are the percentage ownership? 1,200 shares, he has additional 400 divided by the total shares is 2,400,000 plus 800,000 times 100%. When you do this, you'll find that he'll have 0.05. And how much money will he have? by exercising the rights? Wealth status. What? How much money? By wealth status means he will have acquired additional shares, which is now 1,600. You multiply by 28.75, which is the theoretical X price, which gives you 46,000. But there will be the cost of exercising the rights, less the cost, less the cost. How many shares? You have in 400 shares, and each is 25. So this gives you 10,000. So the money that you will have, the current wealth will be that 6,000. That is assuming he decided to exercise the rights. What about if he decided to sell off? That means he sell the share to someone else, sell the rights. What if he was to sell the rights? The ownership, meaning by selling, means there will be no any additional shares. So percentage of ownership will remain the same. But we shall have 1,200 divided by 3,200. Why having 3,200,000? We are seeing that initially we had 2.4 million. When we issue the rights, there is additional 800,000. So this one times 100%, it gives you 0.0375%, meaning that the percentage of ownership decreases. Now, we look at the wealth. How much money does he have? Wealth now. The number of shares are not changing. 1,200 times 28.75. This is 34,500. The value of selling, if he decided to sell those shares, he will sell at the theoretical X price. Value of selling. He will sell those 400 shares at 28.75, giving 11,500. But there is the cost of buying. Cost of buying. And you have to buy them and then sell. Cost of buying is 400 times 25. You subtract 10,000. So at the end, if he decided to sell the rights, he shall have that 6,000. Finally, he can ignore. He can decide, do nothing. Can say, do nothing. Or ignore. If he decides not to do anything, percentage of ownership will have 1,000. Even if you do nothing, people will still buy those shares anyway. So the shares will increase by 800,000. This gives you 0.0375%. But the money, the wealth, is the one that is not changing. Wealth status, you will still have 1,200 multiplied by 28.75, 34,500. So, if you are to advise this person, doing nothing is quite expensive. It's quite expensive. You better either sell these rights or just exercise the rights. So those are the 3 options that are available to this gentleman if he has to exercise the rights or sell the rights or do nothing. Otherwise, we stop there. That's how you are to do this question for you to get the 20 marks. We meet in our next video. Bye.